Sabyasachi Majumdar. As Senior Vice President and Group Head Corporate Sectors Rating, Mr. Sabyasachi has been associated with ICRA for over 2 decades. He is responsible for ratings in the corporate and infrastructure sector, specializing in power, telecom, cement, sugar, and engineering sectors. Mr. Sabyasachi is also responsible for carrying out the integrated ratings of state-owned discoms on behalf of the Ministry of Power and PFC REC. Today, Mr. Sabyasachi will be talking about the Indian power sector outlook. So let's welcome Mr. Sabyasachi.
To share our perspective on the power sector. So basically, I have a general presentation on how we look at the power sector, what are the outlooks and challenges. So basically, we'd start off with brief outlook on the electricity demand, thermal PLF and capacity addition. 2020 was a very bad, 2020 was already a weak year. And in 2021 also, overall, the demand growth rate was not very good because of the COVID-related issues. Now in FY 2022, we expect the whole year demand growth at 8% against 9.6% seen in the first 9 month basis. But obviously this is on a very low pace and mainly driven by the recovery in the economic activity and lower than normal monsoon in the earlier part of the season, leading to higher demand from the agriculture segment during the July month. Also, if you look at, if you compare it the 9 months of FY 2020, then also it's still higher by about 4.9%. For FY 2023, we expect the demand to grow by about 6.5%. But again, it would also depend upon the growth prospect for the economy and also, any further emergence of a potential future wave or consequent lockdown will remain a key monitorable. So for FY 2022, we are looking at a thermal PLF of around 58.5 to 59% against 54.5% in FY 2021. And for 2023, based on our current demand projection, we are looking at a very minor improvement to about 60.4%. However, it still remains quite weak, as compared to the normative 70% plus, which is necessary for the thermal power sector to be, operating at break-even levels. So overall, the thermal PLF will continue to remain under pressure given the growing share of RE in the generation mix, which in turn is being driven by the strong policy support and improved tariff competitiveness. In 2022, there has been a sharp jump in capacity addition, which was led mainly by renewables. As you can see, during 2022, in the first 9 months, we added about 9 gigawatts, which is actually higher than what was seen in FY 20, which was the pre-COVID year, 9 gigawatts. And for the full year, we expected to end at about 12.5 gigawatts, whereas thermal would be at around 6.5 gigawatts. These are basically mostly the older capacities which are being completed now, while hydro would have a very marginal addition of 400 megawatts. Going forward, also, we expect renewables to remain the key driver of capacity addition going forward. And the improvement in capacity addition was mainly because of the significant pipeline which existed, which could not be implemented in, let's say, FY 20 or 21 because of COVID-related disruption, but which are now getting completed. Now, India's commitment at the COP26 has put the focus on renewable energy. The Honorable Prime Minister has presented 5 elements to deal with the climate change. Basically, we intend to increase the non-fossil power capacity to 500 gigawatt by 2030. 50% of the energy requirement is proposed to be sourced from renewable sources by 2030. And we will reduce the total projected carbon emissions by 1 billion tons from now till 2030. And the carbon intensity of economy is to be reduced by less than 45% by 2030, with a target of ultimately achieving the net target of net zero by 2017. Now, if you look at how we project the generation capacity mix to increase, we have taken 2 scenarios. One scenario where is a very aggressive ramp up of renewable energy and also the overall capacity. So from March 21, where we had a total capacity of around 400 gigawatts, out of which coal was a little over 50%, while hydro was around 25% and renewable both were roughly around equal at around 20-25% each. By 2030, in the more aggressive scenario, we are expecting 780 gigawatts of overall power sector power capacity, with almost 60% of 450 gigawatts being driven by renewable energy, while thermal would be stagnating at around 230 or 30%. But even in a less aggressive scenario, we are expecting the capacity to go up to 630 gigawatts, out of which almost 50% or 300 gigawatts will be renewable, about 230 gigawatts will be thermal, the rest will be mainly hydro and gas, liquid, etc. So there is no question about it that renewable energy is going to be the mainstay of a capacity addition in the future. Let's look at what is happening in the power distribution side. This is the most difficult leg and the most challenging leg of the Indian power sector, and there have been very significant delays in tariff determination by the various discoms, while the tariff hikes which have also been approved have been very minuscule. As you can see from the chart on the left, the number of states issuing tariff orders in a timely manner has declined in FY19 and 20. Although, of course, it can be understood given the circumstances, and the number of states giving upward tariff revision has also been stagnating. Whereas in 17-18, almost 20 states had given higher tariff revision, but in 21 and 22, it has been very low. Moreover, even in the states which have actually given tariff hikes, barring Karnataka, which showed a 4% tariff hike, most of the other states have been very low single digit. In fact, at times even less than 1%. And what is worrisome is that many key states such as Rajasthan, Telangana, Tamil Nadu, and West Bengal have not issued tariff orders. And also the extent of tariff hikes over the past 5 years has remained nil or very low in most key states except Karnataka and Madhya Pradesh, in spite of the rising power procurement and O&M costs. As you can see from this, chart, about 77% of the power of the total cost structure consists of power purchase costs, and for that reason, it's important for tariffs to be passed through. As you can see from the bar graph on the right, power costs have been increasing from about 4 rupee 10 paise from FY 2026 to about 4 rupee 70 paise, but it has not been marked by corresponding increase in the tariff level. So it really creates pressures for the profitability of the discom utilities going forward. So there's a rise in imported costs. There are various costs, various headwinds which are going to create problem. These are basically rise in imported coal prices, likely revision in domestic coal prices. So these are all going to cause an increase in the cost structure. So basically, any 10% rise in domestic coal prices is expected to increase the variable cost of power purchase for generation company by about 3.5%. The last price revision by CIL was in January 2018. Given the fact that they have not increased the base price for 4 years, it makes it quite likely that they may do sometime in the near future. Also, the imported coal prices have increased and have reached multi-decadal high, given the higher demand from China, as well as weather disruption in their domestic coal production. Further, the demand for coal has been higher from Europe due to higher natural gas prices. The fuel cost of generation for imported coal-based units at coastal locations is estimated to have increased by 65 to 70% for projects using coal with GCV of floated 200 kcal. So basically, if we are going to assume an increase in upward revision in domestic coal price by 10% and also factor in the higher import price, that itself would add about 1.5 to 2% on the cost of power supply. And this, of course, would vary up across the discoms depending upon the mix of supply from domestic and imported. So timely pass-through of cost variations to tariffs would be very important for sustainable improvement in the financial performance of the state distribution utilities. So timely implementation of CapEx schemes with a focus on efficiency improvement remains important. As we know that Uday had suggested that the AT&C losses be reduced to around 15% by FY19, but clearly that has not happened. Although there has been some reduction in AT&C losses, it remains much weaker than what it was envisaged. We are still about 5-6%, although in fact we have passed 2020, more than 2 years have passed beyond the target rate of FY19, but we are still about 5 to 6% higher as compared to the target. So it's very important that all these states take very serious proactive measures in terms of capex as well as operating procedure to reduce the losses to about 15%. So coming to the discom debt levels, what it has meant is that we expect that the total discom debt levels to again cross 6 trillion rupees and go back to, in fact, pre-Uday it was around 4.5 trillion rupees, but now in spite of the very significant amount of debt takeover which has taken place, again is likely to increase and reach about 6 trillion rupees. And this is being driven mainly by the loans availed from PFC and REC under the liquidity package. Apart from the capex related debt, the funding of losses, regulatory assets and recoverables from the state government and state government bodies have contributed to high level of discom debt. The cash gap for discoms remains high at all India level. We believe, based on our estimate, that for FY 2021, the cash gap would have been somewhere close to 65 to 70 paise. And although there might be an improvement in FY 22 and 23, it will still remain at very high levels at around 54 paise, 50 to 55 paise. And as we can see from the states, apart from a few states like Gujarat, Haryana, which have positives, or other states like Karnataka or Uttarakhand, which have very low gap, many of the other states have very significant gap. For example, states like Tamil Nadu, Telangana, Rajasthan, Uttar Pradesh, West Bengal, Bihar, all of them have a fairly high gap between what they earn and what they expend on sourcing 1 unit of power. So distribution sector remains the key to turn around on this discom finances. Given the history of slow progress in improving operating efficiencies and lack of timely tariff revisions, delicensing privatization seems to be the only way out in turning around the distribution segment. Discom should make use of solar power for supply to agriculture feeders to improve efficiency and lower subsidy dependence. Effective implementation of CAPEX initiatives under the revamped reform schemes, including smart metering, remains key to improving the operation efficiencies. Implementation of direct benefit transfer of subsidies is likely to reduce delays in subsidization from states and improve accuracy in billing and collection for discoms. However, strong political will be required for implementing this. In terms of the budget measures, we expect that augmenting long-term financing avenues to achieve renewable capacity charges is very important. There needs to be measures to improve investments in the energy storage segment. There needs to be augmenting funding outlay for the PLI scheme for manufacturing of high efficiency solar modules. But most importantly, measures are needed for improving the financial viability of the distribution segment, including delicensing in the electricity distribution segment. So on that note, I end my presentation.